Welcome to Breaking News to Trading Moves. Have you ever felt guilty for, losing your focus or maybe making an emotional decision right when the pressure was dialed all the way up?
I mean, I think we all have at some point.
Right. And if you're nodding your head right now, I need you to hear this. Relying on pure willpower to get through those high stakes situations it's actually a complete setup for failure.
Yeah, we're always taught that mental toughness is the ultimate answer,
Yeah.
right? But the data actually points in the exact opposite direction.
Exactly. So today, the mission is to connect the dots between three seemingly totally unrelated arenas. We're looking at high stakes financial trading psychology, the automated strategies of top tier hedge funds, and this is wild, a brand new 93 agent artificial intelligence simulation designed for Mars settlement.
It sounds like a lot, but the central thesis here is really quite simple. Success in high-pressure, resource-scarce environments, whether you're managing a volatile portfolio or literally trying to survive on another planet, it isn't about trying harder.
Or just having more personal discipline.
Right. It's about building structured systems that make bad decisions difficult and, good decisions automatic.
So, to understand why we need these structural systems, we first have to look at why human willpower consistently fails us in high stakes environments like financial trading, because the failure rate is staggering.
Oh, absolutely. And the mechanics behind that failure are thoroughly documented. If you look at the FIDE cryptanalysis and the reporting from Judo Markets, the core problem is that willpower is, well, it's a fragile, depleting resource.
How so?
Think of it like the structural integrity of a submarine. You plunge into the water fresh, your rules are clear, and you feel entirely in control.
Right.
But the longer you stay submerged under intense psychological pressure, the more microscopic cracks form in the hull. And eventually those cracks lead to a catastrophic implosion.
Yeah. I mean, you watch a trade almost hit your profit target and then it reverses and you just have to force yourself to hold the line. That takes a toll.
A massive toll.
The cognitive load just burns through your reserves while you're sitting there watching the screen. And relying on that motivation leads to complete burnout, which triggers what the industry calls revenge trading.
Yeah, revenge trading happens when the submarine finally cracks. A trader just snaps. They start over-leveraging and breaking every established rule.
And it's not because they forgot their parameters, right?
Exactly.
Mm.
It's because they're mentally exhausted. And even if they don't blow up their account in one dramatic event, this lack of discipline manifests as transaction cost accumulation.
Oh, this is a hidden killer for retail traders. Walk me through the actual math of how that works.
So instead of waiting for, say, 10 well-planned entries a month, an exhausted trader might churn their account. They make 30 trades out of boredom or, anxiety.
Just clicking buttons to feel like they're doing something.
Right. And every time you enter or exit a position, you pay a spread, a commission, or both. So even if those extra 20 trades essentially break even on the chart, the trader's eating up 2 to 3% of their annual returns just in broker fees. Yeah, those small discipline breaches compound dramatically over time. It just bleeds the account dry.
And traders are incredibly good at lying to themselves about why they break those rules too. I was looking at a discussion in the Reddit options community, and retail investors were talking about how they constantly change their position sizing based on their quote-unquote conviction.
Yeah, that is a classic trap. On the surface, adapting your size to the market conditions sounds totally valid.
Right? It sounds like you're just being smart.
But the users admitted it frequently becomes a psychological loophole. They rationalize overriding their own strict risk parameters. Just because they really like a setup, they use the word conviction to mask a breakdown in discipline.
Which perfectly illustrates the framework laid out by trading psychologist Mark Douglas. He identified 3 stages of becoming a consistent trader. First is mechanical execution, where you follow a rigid set of rules blindly.
Almost like a robot.
Exactly. Second is subjective interpretation, where you start adapting to context. And finally, intuitive mastery. The problem is that traders experience a little bit of early success and immediately try to skip the mechanical stage.
They absolutely do.
They rely on their so-called intuition before they've actually mastered their own impulses.
And relying on discipline at that stage is, well, it's like trying to diet by keeping junk food right on your desk and just trying really hard not to eat it.
Instead of just not keeping it in the house to begin with.
Exactly. You're relying on resistance rather than environment design.
Wait, hold on though. If discipline is a trap and our brains are constantly looking for ways to rationalize bad behavior, What is the actual alternative when real money is on the line?
Financial professionals remove the human element entirely. They build rigid, systematic guardrails.
Okay, give me an example.
Well, Go Markets detailed some of these interventions. They range from simple decision trees like, if the price drops to X, execute Y automatically, to extreme technological lockouts.
Lockouts, like they block themselves.
Literally. Traders program their brokerage platforms to prevent them from opening any new positions after 2 p.m. simply because their own performance data showed their afternoon decision quality was terrible.
That's amazing. They take the decision completely out of their own hands. Another fascinating method involves extreme pre-commitments. There are arrangements where if a trader breaks their own risk rules, a smart contract automatically forces a financial donation to a political cause that the trader vehemently opposes.
Yeah, nothing keeps you in line quite like knowing your mistake is going to fund your political rival. It creates an immediate, painful consequence that overrides the temporary emotional desire to take a bad trade.
That is brutal but effective.
Very. But these individual guardrails are really just the beginning. Institutional capital scales this concept up massively. The Nordic Hedge Funds report breaks down how systematic trading inherently removes behavioral biases.
Like the herd mentality.
Exactly. Take Jupiter Asset Management, for example. They use advanced computer models to process an absolute overload of market data. Human beings naturally herd together. We see excitement over tech stocks and we want in.
FOMO is real.
It is. But Jupiter's algorithms dispassionately evaluate the data without that FOMO. It allows them to avoid following the crowd into hype sectors.
What's really captivating about the institutional space is how different funds apply these rigid systems in completely different ways. You have a firm like SMN in Austria. Their systematic approach is all about casting an impossibly wide net. They trade over 100 different markets, including things like cocoa and sugar.
And the logic behind that is pure statistics. Trend following typically has a win rate below 50%. You lose more often than you win.
Which sounds crazy for a hedge fund.
It does, but to make the math work, you just need to catch massive outsized trends when they happen. So by automating their system to scan 100 markets, SMN increases their probability of catching a crazy outlier.
Like cocoa quadrupling in price.
Right. And they do it while keeping their emotional attachment at absolute zero.
But then you look at dynamic beta investments, or DBI, and their systematic approach is the exact opposite. They don't want to trade 100 obscure markets. They use a mathematical process called quadratic optimization,
Which is an elegant system that warrants a little bit of explanation. Instead of trying to guess where the market is going, quadratic optimization analyzes the daily return streams of the top trend-following hedge funds.
Okay.
The algorithm uses regression math to figure out what combination of the 10 biggest, most liquid futures contracts, like the S&P 500, gold, or 10-year treasuries, would produce that exact same performance line.
Wait, so they just clone the result?
Essentially, yes. It clones the result without cloning the messy, complicated process.
So by restricting themselves to just 10 core contracts, they avoid getting chopped up in the violent, unpredictable price swings that often happen in niche commodity markets.
Precisely. They accept that they might miss a wild sugar rally, but their system protects them from the associated volatility.
And these systems are constantly navigating massive macroeconomic currents. Torsvellin pointed out that as the tech rally takes a breather, we're highly likely to see capital aggressively flow back into the commodity space.
And the algorithms are built to catch that rotation automatically without a human needing to, read the tea leaves. The system dictates the action, not a portfolio manager's gut feeling.
Doesn't that completely ignore the value of human intuition, though? I mean, a seasoned discretionary trader can read market psychology or pick up on geopolitical news in a way an algorithm just can't compute.
Well, discretionary traders absolutely have a place, especially during unprecedented geopolitical crises where historical data is basically useless.
Right.
However, the crucial caveat is that even the most brilliant discretionary traders must operate within strict, predefined risk structures to survive.
Yeah.
They might choose the specific trade, but the system dictates the maximum position size and the absolute stop loss. The guardrails are still there.
Okay, so we've seen how hedge funds use algorithms and strict parameters to stop humans from making emotional mistakes. But what happens when the intelligence making the decisions isn't human at all? That brings us to the Agent Mars simulation.
Yeah, because if we can't trust humans with unconstrained freedom in finance, we certainly can't trust autonomous AI agents in an open environment when oxygen and power are literally on the line.
This Mars simulation is mind-blowing. It's a massive testbed designed for multi-planetary operations. The whole point is to solve the problem of AI agents operating in open sandboxes. Like, we've all seen AI do cool things in isolated tests, but what happens when you put them in charge of a base?
Right. And the researchers formalized an incredibly detailed operational organization. We're talking about a roster of 93 distinct agents.
That's a lot of AI.
It is. 71 of them represent human roles,
Hmm.
and 22 are physical asset controllers, like the actual software running an airlock or a nuclear reactor.
And they aren't just thrown into a chat room together to figure it out. They're organized into 7 rigid layers of command, starting from strategy and governance at the top, down to mission operations, civics and well-being, infrastructure, science, and finally, the robotic assets at the very bottom.
This brings us to their core coordination paradigm, which they call hierarchical and cross-layer coordination, or HCLC.
Okay, what does that mean in practice?
Well, by default, the system enforces a very strict chain of command. A geology agent can't just directly command a cargo rover. The request has to go up the chain to operations, get approved, and come back down. It maintains total accountability.
But if these AI agents can process information instantly, why artificially throttle them with a corporate-style hierarchy? Why not let everyone talk to everyone? It seems like you're just adding bureaucratic red tape to supercomputers.
Think back to the trading firms we just discussed. Unrestricted communication erodes safety gates and creates absolute coordination chaos.
Because there's too much noise.
Exactly. If every AI agent is constantly pinging every other agent, you get alert fatigue, conflicting commands, and a complete loss of an audit trail. You need clear authority.
But what if there's an emergency? Red tape could literally kill you on Mars. Let's say a sudden solar flare threatens a rover on the surface. Waiting for operations to stamp a form might take way too long.
And that is the genius of the HCLC system. While the default is strict hierarchy, the system includes specifically whitelisted, auditable cross-layer shortcuts.
Oh, okay, so they can bypass it if needed.
Yes. In your solar flare scenario, if the geology team urgently needs the AI mapping drone to navigate the rover to safety, they have a pre-approved shortcut to communicate directly. The system logs the interaction for auditing purposes, but allows the critical delay to be bypassed. It balances safety with necessary speed.
That makes a lot of sense. But establishing a hierarchy is only the macro-level solution, though. On a micro level, these agents need specific protocols to manage disagreements and misunderstandings, which mirrors human organizational psychology perfectly. Let's look at their memory structure. They use a scenario-aware memory module.
Because if an AI doesn't have the right memory constraints, it either forgets what it was doing entirely, or it gets bogged down processing its entire history every time it acts.
So the agents are equipped with a short-term window for immediate context, what just happened in the last few minutes, functioning almost like human short-term RAM. But they also utilize a distilled long-term store.
Right. And this prevents the agents from endlessly re-asking earlier questions or repeating resolved debates.
Give me an example of that.
Sure, if the agriculture agent already confirmed the soil fear levels yesterday, the distilled memory stops it from querying the geology bot again today. That saves precious computational resources and time.
Speaking of debates, how do they handle conflicts? Let's paint a picture here. Imagine the life support agent desperately needs extra power for oxygen scrubbers during a dust storm, but the agriculture agent insists on maintaining power for greenhouse lighting to keep the crops alive.
That's a great scenario. They utilize a proposed vote consensus mechanism.
How does that work?
Rather than any single agent unilaterally executing a command that drains a shared resource, the agents broadcast their proposals to the relevant group. They then vote on the best course of action until a quorum is reached.
And the default quorum in the simulation is 60%. So it forces them to negotiate and find a mathematically acceptable compromise like, I don't know, running the scrubbers at 80% and the lights at 40% before anything physically changes on the base.
Exactly. It completely removes the risk of a rogue agent making a unilateral decision that dooms the mission. But there's another layer of friction they had to solve, and that is language.
Yes, the heterogeneous technical language protocols. This is an incredibly clever part of the simulation. Different scientific and engineering departments use entirely different jargon.
They do.
Yeah.
And direct exchanges across those groups risk fatal misinterpretations.
Like, if a geology agent tells a life support agent something using highly specific rock terminology, the life support agent might not compute the actual physical danger.
Spot on. So the researchers introduced a translator agent to sit right between them. Let's say a machine learning algorithm scanning the surface detects something and outputs the phrase, hydrated silicates.
Okay.
The translator intercepts that message. It converts hydrated silicates into the phrase volatile signature. That way, the AI asset controllers running the heavy machinery actually understand what to look for and how to react, and it logs a complete audit trail of the translation.
It's a brilliant systemic solution to a very human problem. That translator agent acts exactly like a risk manager at a hedge fund, sitting between the hyper-technical quant developers and the fast-moving floor traders, ensuring nothing gets lost in translation.
That's a perfect analogy. The risk manager doesn't generate the profits, and the translator doesn't find the water on Mars, but without them, the entire system collapses under the weight of miscommunication.
Wow. Are there other fail-safes?
Yes, the simulation also features dynamic role switching, which is crucial for redundancy. If a primary asset controller goes offline, say, the AI running the airlock gets corrupted by radiation control, seamlessly hands over to a designated backup.
So no single point of failure.
Exactly. The system doesn't panic, it just executes the pre-planned structural handover.
Let's pull all of this together. We started with a retail trader staring at a screen, setting their software to lock them out of their brokerage account after 2 losses so they don't revenge trade.
Then we scaled up to multi-billion-dollar hedge funds, utilizing rigid mathematical optimization and algorithmic filters to actively avoid the behavioral biases of the herd.
And finally, we looked at a 93-agent Mars simulation that relies on strict command structures, voting quorums, and dedicated translators to keep artificial intelligence from spinning into coordination chaos.
And the overarching lesson across all 3 of these domains is identical. Success requires completely abandoning the fragile illusion of willpower in favor of ironclad systems.
When the stakes are life, death, or your entire life savings, you cannot rely on simply trying harder. You have to engineer an environment where failure is structurally difficult.
Precisely.
So I want to challenge you directly. Look at your own life. Look at your workflow, your investments, or your daily routines. Where are you currently relying on motivation or sheer discipline when you should actually be building a system that enforces good habits? Where is the junk food still sitting on your desk?
It's an important question. And as AI agents become increasingly capable of executing highly complex, multi-step tasks, perhaps the most valuable human skill of the future won't be doing the mechanical work ourselves.
Will it be?
Rather, our greatest value will be designing the strict psychological and structural environments that keep those autonomous systems from making our very human mistakes.
It all comes back to the foundation. When the pressure is on and the reality of the situation is murky, you don't rise to the level of your goals. You fall to the level of your systems. Thanks for joining us.